You know, it takes a very special kind of magic to post a 783% jump in that earnings when your actual sales are shrinking. You are listening to Earnings Unscripted, where we unpack what really happened in today's earnings. Today is March 5th, 2026. We are looking at Canadian Natural Resources, ticker CNQ, and their fourth quarter 2025 results. It was a quarter of record production, really wild accounting, and some fairly pointed political messages. So, Miro, what is your first take here?
Magic is actually the perfect word, or, well, maybe just accounting alchemy. Look, the headline numbers are absolutely insane. They printed a massive $5.3 billion in net earnings. That is $2.54 a share. But, and this is the crux, revenue actually dipped 3% quarter over quarter down to $10.71 billion. Production was fantastic. They hit a record of roughly 1.66 million barrels a day. The problem is prices they kind of worked against them.
Right. Quick reminder before we get too far into the weeds here, this is not financial advice, just our personal opinions on the market. But wait, hold on. How exactly do you print an earnings spike that big if the top line is actively shrinking?
Oh, it is a pure paper illusion. I mean, they did an asset swap with Shell to take full ownership of the Athabasca oil sands project. And when you do that, GAAP accounting rules basically force you to revalue your existing 90% stake to the current fair market value. So out of nowhere, boom, they recognize an almost $5 billion non-cash gain.
Wow.
Yeah, it is just spreadsheet money. If you strip that swap out, their adjusted operating earnings actually fell 5% to $1.71 billion.
Okay, so a $5 billion spreadsheet flex, which is genuinely wild. But you know what actually stood out to me more than the financial gymnastics? The human element.
Mm-hmm. Safety, right?
Yes, exactly. I mean, they are running these massive, heavy oil sands mining operations. It is an incredibly brutal physical environment for both people and machines. Yet they pushed these record industrial volumes while dropping their injury rate to the lowest level ever recorded in company history. To me, that is real-world execution.
It really is. You absolutely have to give them credit for managing that kind of operational tempo. But it is interesting. I think the market saw through the accounting noise today. The stock action was just a total roller coaster.
I saw it open strong.
Yeah, it spiked up around 45.80 at the open, but then investors seemed to read the fine print. It sold off pretty aggressively right through the 11 o'clock earnings call. Dropped to about 44.40 by early afternoon, but then buyers just slowly stepped back in and pushed it to a functionally flat close. Finished at $45.32, up a grand total of 0.04%. Extended hours were totally flat.
Okay, so basically a giant round trip to nowhere by the closing bell. I guess investors were trying to digest the huge accounting bump alongside the fact that they just shelved a massive mining expansion. Because if I read this right, they parked an $8.25 billion project and literally blamed it on the government.
Yeah, the Jack Pine mine expansion, the CEO basically said the math does not compute due to uncertainty around Canada's carbon pricing and methane policy. So they are just putting a hard freeze on that capital. And what is really interesting is since they are not spending it there, they effectively moved their own balance sheet goalposts to trigger share buybacks instantly instead of later this year.
All right, let us get into the details on that, because pausing an $8 billion growth engine while actively changing your own rules to speed up payouts, that is a massive strategic shift.
It really is a massive shift. I mean, usually when management sets a debt target, it is set in stone, right? It is a rule you follow.
A finish line, essentially.
Exactly. So their old rule was that they needed to get net debt below $15 billion. Once they hit that, they promised to distribute 75% of free cash flow back to shareholders. But they ended the fourth quarter at, roughly $15.9 billion.
Okay, so they are incredibly close. Like, a normal company just tightens the belt for a quarter and naturally crosses the line.
Right, you would think so, but instead, the CFO, Victor Durrell, gets on the call and literally just redraws the map. He said, and I am quoting here, when net debt is below CAD 16 billion compared to the previous target of CAD 15 billion, we will increase shareholder returns to 75% of free cash flow generated.
Wait, they just arbitrarily raised the ceiling by a full $1 billion?
Yep. By doing that, they are instantly eligible. The capital tap just flings wide open for the first quarter of 2026.
Wow, that is some serious confidence. Or maybe impatience? Like, why the rush to flush that cash out right now? I guess if you literally just parked an $8 billion mine, you kind of have cash burning a hole in your pocket.
That is exactly it. With the Jack Pine mine frozen because of those carbon pricing uncertainties, their capital expenditure actually dropped by 42% sequentially. So they're generating this mountain of organic cash. But Susie, I think the deeper reason they feel comfortable moving the goalposts is because of what they actually own. It is the manufacturing illusion.
Hold on, the manufacturing illusion? Unpack that for me.
Sure. So a traditional oil explorer is always fighting decline curves. You drill a well, it pumps a lot, then it slowly dies. And you have to spend more money to drill another one just to replace the lost volume.
Right, the Red Queen race, running just to stay in the exact same place.
Perfect metaphor, yes, but Canadian Natural operates differently. Robin Zabek, the E&P CEO, highlighted this on the call. He noted that approximately 50% of the company's total proved reserves are high-value synthetic crude and mining bitumen reserves with zero decline.
Zero decline? I am sorry, how is that even physically possible?
Because it is mining. The oil is sitting right there in the sand. You just dig it up. It does not lose geological pressure over time like a conventional well. They essentially lock in these multi-decade assets. Zybeck was saying they have a 31-year reserve life index. So they view themselves more like an industrial factory complex than an oil wildcatter.
Okay, that makes sense. So if the factory is fully built and the government will not let you build the next factory, you just hand the factory's profits back to the owners. That actually sounds incredibly safe and kind of bulletproof.
Well, yes and no. That is the Canadian side of the business.
I hear a but coming. What is the catch?
The catch is overseas. Because while they're touting this indestructible factory at home, they are bleeding out over their legacy offshore assets. The reality of end-of-life liabilities hit them hard this quarter.
Oh, the write-downs. You mean the $1.78 billion charge they booked?
Exactly. So look at their operations in the North Sea, the Ninian platform specifically. They went out to get competitive tenders for decommissioning and abandoning that asset, and the costs apparently just blew out wildly over budget. Add to that their T-block assets, which they basically threw their hands up and declared no longer economically viable.
Jeez, so they had to debook those reserves entirely. That is kind of the ultimate contrast, right?
Totally.
You have these invincible 30-year assets in Canada that print money, and then you have these decaying metal structures in the ocean that are suddenly costing billions just to clean up. It feels like two completely different companies taped together.
It really is. The liabilities are real, and they can spiral fast when environmental rules tighten. It is a harsh penalty flag on their balance sheet, but because the Canadian cash flow is so overwhelmingly strong right now, the market kind of gave them a pass on that $1.7 billion international cleanup bill.
Quick sanity check on the big picture then. With so much structural change going on, the weird write-downs, the paused megaproject, the shifted targets, where does all this actually leave them heading into next quarter?
Well, it leaves them aggressively leaning into what they actually can control. Because honestly, the guidance they just dropped for the upcoming year is remarkably bullish.
Okay, so give me the numbers. Are they pumping more or less?
More. Quite a bit more. They bumped the midpoint of their 2026 production target up by 20,000 barrels a day. The CEO, Scott Stouth, was pretty blunt about it. He said, "We are increasing the midpoint of our 2026 production guidance by 20,000 BOEs per day And we are reducing our operating capital forecast by $310 million. So their total spend is down to about $6 billion.
Wait, hold on. They are cutting their capital spend by over $300 million, but increasing output? I mean, that is kind of the holy grail of operations, right?
It is exactly what Wall Street wants to hear. It shows brutal efficiency and very high rig utilization. They're just milking the assets they already have. But, and here is the major risk going forward, they had a huge external tailwind this quarter.
Let me guess. Geopolitical premiums?
Yeah, exactly. The CEO admitted that tension in the Middle East tightened up the U.S. Gulf Coast supply. That pushed the price of their heavy crude much closer to the WTI benchmark. It was a massive pricing favor for them. So if that conflict premium deflates next quarter, their margins might compress even with that record production rate.
So basically, they are executing almost flawlessly on the factory floor, but they are still completely chained to global politics and local regulators, which is, kind of the eternal tragedy of the energy cycle.
Precisely. They control the volume, but the rest of the world controls the price.
That is a brilliant way to frame it, and definitely something we will keep an eye on next quarter. All right, that about does it for a deep dive into CNQ.
Anyway, we will let the market sort that out. If you want these earnings chats to just show up in your feed, feel free to follow the podcast. We run this project with a little AI help to extract the actual human stories from those giant corporate filings. If you have a ticker you want us to cover, drop an email to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for listening, and we will catch you after the next bell.
Take care, everyone.